What are the opportunities right now? Not the next 6 to 12 months, like right in front of me on the screen right now.
I think right now you've still got, you still have to focus on places that have shown the quality leadership: industrials, energy, materials, some of the pro-cyclical nature as the economy does recover. We're fading a little bit more of technology. We think financials may be a little bit overbought here. They've had a really nice run. So I think, you've got to look for those select spots where you're not paying up in valuation. The earnings season will be interesting. So if you look at just quarter over quarter earnings, there's only 2 GIC sectors in the S&P that are going to actually show positive sales growth from last quarter to this quarter, and that's financials and utilities. Everything else is down, and something like tech is down 8% on sales and 20% on earnings quarter over quarter.
This is the equity market. Why isn't the bond market just a screaming buy right now? If I said to people back in December who missed out on the juicy 5% yields of October, you're going to get a second bite of this in March, April time. Do you want it? They'd say, yes, absolutely. Give me a second bite of that. Here it is. People don't come on the program screaming, buy bonds, buy bonds. Why is that?
Well, 2 points there. One is I do think you're starting to get duration to be a good buy. It's a little bit of equivalent to picking up pennies in front of a steamroller, right? People are grabbing for basis points on the short end of the curve, right? Everybody's crowded the short end of the curve, and you're grabbing for 5, 10, 15, 20 basis points. But if I've got a bond portfolio that has a 8 duration, let's say 7 or 8 duration, and rates do drop 1%, I make 700 or 800 basis points, right? So the point on duration is the right one, right, to start extending here. The most important point, I think almost entire Wall Street's missing right now, is the yield curve has changed metamorphically, and nobody's talking about it, right? So if you talk about the 5-year out, we're almost tabletop flat, right? 5, 7, 10. And there's only 5 basis points of difference between the 5-year and the 30-year with just very mild steepness, right? So you're getting a little bit of steepness, the long end of the curve still buying into the soft landing. Where's the short end of the curve? Killingly inverted, right? 3-month to 2-year is 40 basis points inverted. That is tabletop inverted. That's telling you a different story. And a lot of the historical studies that you would look at will tell you that the signal versus noise, the front side of the curve tells you much more information than the back side of the curve or the tail of the curve. So pay attention to the short side, because that side is still telling you you got some tougher waters to navigate ahead, which brings us full circle to where we think you'll get some better entry points down the road.
In particular, you said fading tech, which was compelling to me, because that seems like actually one of the stalwarts that a lot of people were talking about, and that you see more downside to go. Can you talk a little bit about where in specifically you do see that? I mean, is that just sort of focused on the Tesla Apple stories that we were talking about, or is this a broader just, things have gotten overbid, valuations are too high, they got more room to fall?
I think a little bit of the latter, right? I think the valuations are stretched here. I mean, when you look at tech, I mentioned a moment ago about 20% quarter over quarter drop in earnings, 8% decline in revenue. So they're going through some challenging times. Lisa, I think what people are also missing under this heading of kind of big themes and changes, massive change inside of tech over the last 6 to 12 months, which is everybody now, and we think investors should be chasing hardware, right? There's been this big shift from capital light, software intensive cloud to now it's all about, AI data centers, hardware. Even the big Googles, the Microsofts are investing, hundreds of billions of dollars in that type of thing. That's a durable trend, we think, for the long term. So within tech, if you're going to get exposure, I think people are still missing the kind of inflection point we've hit from the last 10 to 15 years of software and capital light basically being all the rage. I mean, think about Google. Google started with $100 million and 1,000 employees, right? And it's probably become one of the greatest firms on the planet, right? Now it's going to be all about who can invest the most money in hardware and infrastructure to build for that next generation.
It strikes me that everyone who comes on this show has less and less conviction as time goes on. When was the last time you had this little conviction about the direction of travel for prices, not necessarily for some of these larger stories of what to look at?
Yeah, so here's what a little bit goes back to John's point. I think what you're starting to see, and I think Andrew talked a little bit about this on the prior segment, there's this bifurcated economy out there, right? And some have talked about it, the high-end consumer versus the low-end consumer, big business confidence versus small business confidence, right? Tech manufacturing spend versus non-tech manufacturing spend. services versus goods, right? So you've got to think about when you're putting your investments in places, I'm oriented towards those places where strength resides, right? And I'm fading those places where the weakness is at, right? The reality is there's still just so much liquidity you guys talk about all the time in the marketplace. It's driving all asset prices higher, right? Regardless. I mean, look this morning, the FTSE setting a new all-time high, German DAX at an all-time high, Nikkei overtook 4,000. You got gold at 2,400, right, which is typically a risk-off asset. S&P was sitting on all-time high. Credit spreads at tights, right? There's just liquidity chasing everything. Doesn't matter if it's risk-on or risk-off assets at this, at today's level. So at some point that starts to separate, and you start to understand, okay, where do I really want to have exposure over the next 3, 6, 9, 12 months? And we think that bifurcated economy theme continues to play.
And around the world, where do you want to have exposure? I know you love the U.S. and
Yes.
you're shrugging off EM, but where in the developed world?
I think if you're going to have exposure in developed world, you still want to be Japan is probably the best country there. It'll be interesting to see if the BOJ has to intervene here at some point to defend the yen on a 34-year low this morning.
We thought 152, then 153, then 154, and now we're basically at 155.
Yeah, I think you've got a bunch of you've got the PBOC that is trying to defend the red line on the Chinese yuan. You've got the BOJ trying to defend the yen. But equities there are doing phenomenally well. And I think Europe is an interesting case. It's a little hard. You almost kind of have to look the other way and hold your nose a little bit, right, when you go to invest in Europe, because when you drill down into the fundamentals, you're not going to see particularly great things. But the markets there continue to do well, and I think for the first time maybe in a decade, you might have this case where developed markets start to challenge the U.S. The first quarter, most people don't realize, developed market equities actually outperformed the S&P by 0.2%. It wasn't by a huge margin, but first time in a long time.
The psychology around Europe always makes me laugh. I remember when I first moved here and someone said it's good for vacations, terrible for investments. And I think people still feel that way about Europe. When you're looking abroad, you're thinking of two things right now, I think, at the moment. One is the strength of the US dollar,
right,
and the other is what's happening in China and how and if I want to expose you to that story. How are you navigating those forces at the moment?
Yeah, the king dollar is just, I mean, we talked about 34-year low in the yen. Against the pound sterling, it's really troubled. The euro is weak. The Chinese yuan is weak, right? There's just no good place to be there from a currency standpoint, probably that makes sense unless you're just deep value hunting. It's interesting, to your point on China, John, if I go back and look at China over the last 2-3 decades, China's never been a good investment. It's been a good tactical trade, right, at moments in time. But if I pull out any, give me a Chinese indice and show me the last 20, 30 years, and I would show you that it's not been a great, sustainable, durable investment, right? Something has to inflect and change there to get us terribly interested there, notwithstanding second largest economy on the planet. So you always, as a lot of people have done over the years, you can play China indirectly without having to have the direct exposure to China. So you play the benefits of the Chinese economy spilling out into the global marketplace.
Just before we let you go, this is a massive week. We get a lot of earnings. Tech earnings really kick off. We get PCE as well as personal spending and income on Friday, and then we get a host of auctions, including today's record $69 billion of 2-year notes being sold at 1 p.m. What do you think is going to be most instructive for you to get a sense of whether we're starting to inflect to that divergence that you've been expecting?
Auctions are always key, right? Because it's the theme of liquidity, right? You hit on this all the time, right? I mean, and the bid to cover ratios have been weak. I guess if I'm watching one thing there, it's not PCE on Friday, because we think we kind of know where that's going to come in, 2.7, 2.8, and you're still a full point difference between CPI. It's earnings, right? We get 30% of earnings this week, which puts you at the 50th percentile mark. If I were to say what's a theme of earnings season so far, and what we've seen for about the quarter of the market cap that's reported for the S&P, it is this. It is weak topside demand with a good defensive margins at this point, right? I mean, so it's a good news, bad news, right? You can clearly see demand is softening and weakening. Companies are doing a great job controlling the cost line and defending that margin line, but you can only do that so long. You do need top line growth to keep driving. And so if we're going to get to this 11.5% consensus earnings, bottoms up, top down, that everybody believes the S&P is going to give us this year, we got to go. Like, we got to get the engine humming here, because first quarter is not looking particularly good. It's looking more like a flat to maybe slightly up, 3-4% on a beat.